Hey everyone, it's Imran from Options Insight, your macro options daily. All right, so last week, stocks finished higher on the week after a month-end rally sparked by Powell, comments being taken dovishly. Still scratching my head as to what was very dovish about that, but markets took it dovishly. I think it's more a sign that markets kind of got a bit ready for a hawkish statement, which didn't really arrive, and then some shorts got unwound. And the reason why we feel that is because some of the most shorted sectors like the ARK ETF were up like 8% on the day. So that is really a sign of a bit of a short squeeze there that we saw on the day. We also had non-farm payrolls on Friday last week, which came in ahead of expectations. And more importantly, average hourly earnings came in double expectations. The initial knee-jerk on the market was down 2% on the S&P, but it managed to find support near that 4,000 level, where there's quite a lot of open interest in terms of December expiry. So clearly some hedging activity going there in the options land. And then the good old zero DTE buyers of calls came back in and ripped the market back up again. And we ended up pretty unchanged on the day on Friday after being down nearly 2%. So pretty interesting price action, and kind of shows you that even when you get a number that looks pretty hawkish on the face of it, the market kind of wants to rally back, right? And needs some real evidence of the Fed being more hawkish, and we're going to kind of probably have to wait until FOMC next week to really find out how hawkish they want to be, and that's going to be the day after CPI, which is another massive print for the market. And if CPI was to come in similar to last month and lower than expectations, then it definitely feels that this market is ripe for a big old short squeeze to the upside, and we may even see 4,200 on the S&P in short order. So that's something to be aware of. European stocks, on the other hand, were pretty muted. They didn't do a lot. They haven't been doing a lot. Realized vol remains pretty low on those. You can see in the single digits. So not really a lot to say on those. Clearly, the recession in Europe, everyone believes is happening or about to happen. Stocks don't really seem to care right now. China, on the other hand, ripping to the upside continues. 12.5% on the week. That's a 2 sigma move on the week. And that market's pricing in a zero COVID pivot, basically. It does seem like those protests and uprisings that we were seeing are having some impact. And we are starting to see relaxation of restrictions all over the place in China. And that's making markets kind of go after this China reopen trade, certainly within the equities market. Now, some commodity markets, you could argue, are not really following through on that. If we look at oil, for example, was up 4% on the week. But if China's really reopening, I don't see why this thing isn't up 10%. You did see the metals, however, rallying. Copper up 6%, silver up 8%. So some really decent moves in the metals, kind of being helped with that that China reopen story, but also because the dollar remains on the back foot. And the dollar's continuing to come off, and that's generally pretty good for these commodities. All right, moving on. If we look at what's going on in FX, etc. So like we said, the dollar getting a bit whacked. We had cable up another 1.5%. We had dollar yen down 3.5%, which is a nearly 2 sigma move on the week. And CNH is obviously down as well on the back of what's going on in China. That was down 2 sigma as well. So the dollar pretty much getting whacked across the board. Obviously, terminal rates being priced down as well in the US. And then bonds continue to charge. So TLT now back all the way to 107, which is pretty impressive given how low it got. Right, it got close to 90. It's back to 107. Another 4% up on the week, and that's a 1.5 sigma move for TLT. Volatility in TLT is starting to finally come down. Down 1.7 on the week, back to 19. But be clear that it's still expensive, because compared to S&P, which is on a 17 handle, TLT tends to trade 2 vols under, not 2 vols over S&P. So you could argue that TLT still has a bit of juice in there. But looking over at the carry side of things, it is realizing it's got a pretty much realized equal to implied. So, it's probably not going to collapse unless the realized calms down, and the realized probably still got some life left in it, given the catalyst that we've got next week. Outside of that, sectors kind of not doing a whole lot outside of ARK. We did see ARK up 6% on the week. Obviously on the back of that big short squeeze after Powell. Volatility getting smashed in ARK, down 5 vols. We're seeing skew down in ARK as well, down 4 vols. So for those of you who do think ARK is still a sell, and you think this kind of rate story isn't done yet, then the bounce that ARK has had and the fact that vols retraced so much, buying puts in ARK might not be the worst idea in the world. Okay, so that's kind of the summary for today. If we move on to what else we're looking at, upcoming events. So this week is expected to be a bit more calm ahead of next week's massive macro data points, CPI and FOMC. So we can see from the S&P implied vol term structure, there's a nice chart put out by Tier 1 Alpha. And basically, because we've got so much granularity now in the S&P options market, and you can pretty much trade every day for the next week, you can trade every single day. So you get quite a lot of granularity, and you can price in exactly which events are being priced at a premium or a discount. And you can see here that you've got the CPI implied volatility around the CPI date. It's a good 5 vol points higher than the expiry just before it. So that 5 vol point jump in implied volatility that's being priced in the short dated options, that equates to a roughly 2% implied move on the S&P on the day of CPI. And that's versus a baseline expectation on the previous days of around 1% per day. So you can see the market's kind of implying about an extra 100 basis points for the CPI day. Now, if we look back at what the CPI has produced historically in recent times, and if we look at what Powell managed to do to the market just with a few words, I think an extra 100 basis points on S&P is probably on the low side of what we're really going to get. So this does feel like it's a bit underpriced right now. Now, we do have ISM services and University of Michigan sentiment this week, along with Bank of Canada rates decisions. None of these are really likely to set off any fireworks. So you can understand why the volatility is a bit depressed for this week. But like I say, I don't think they're pricing enough premium for the kind of shock we're likely to see on CPI and maybe even on FOMC, depending on how hawkish Powell actually is in his press conference. And that's what he does tend to do. If the markets do rally too much, let's say CPI comes in light and the markets rally a lot, then there's more incentive for Powell to be more hawkish, and that probably sets up that FOMC to be an event in itself. Anyway, so those are things to kind of think about. But the VIX has continued to break down. You look at the VIX; it's back to 19 on the VIX spot. It's been getting hammered, and something might explain that is the idea that because these zero DTE options are being used as a tool for macro hedging and for all these data points that come, people just buy the options that expire the same day. Historically, they used to use the front month options, which were basically how the VIX is priced, right? The VIX is the 30-day rolling implied vol, so it's priced off 1 month options. But if there's not as much demand for 1 month options because everyone uses 1 day options, then that makes sense that the VIX comes lower because those 1 day options are taking over the flow. They're not priced into the VIX, and the VIX people are just saying, well, I don't need to buy an option for a month. It's just too much premium. Some people have said, why buy it when I can rent it? Basically, why buy the protection when I can rent it? And buying it for 1 day is like renting it, and that's what people seem to be doing, basically. Right. So I do personally think the VIX has overshot a little bit to the downside. So I wouldn't be surprised if we do see some bounce over the next week as we go into that date, as we go into those 2 big dates next week. But the reality is, given what the VIX is doing, it kind of shows you that the street is not really wanting for volatility right now. And so even if we do get a kind of brief pop, you would have thought after FOMC, the VIX is headed back down again, especially going into the seasonally quiet period of Christmas. So I wouldn't be surprised if at some point by year end, we see an 18 or lower level on the VIX. All right, that's what we're looking at. Now, going towards sort of the idea side of things, what's screening, what's flagging to us, we look at gold. So gold has obviously benefited from the move down in the dollar and the lower real yields that we've seen, and it's rallied all the way back up to its 200-day moving average. So big inflection point for gold. This happens to be the old highs back there in the summer, and it's also the 200-day moving average. So quite an important resistance zone. If it does break to the upside on one of these big catalysts next week, then we could easily see quite a bit more upside in gold. We're talking $4 and then maybe another $5. So somewhere between $5 and $10 upside potentially still in gold if we do get a break higher from this level. Silver's obviously already started to go, and silver's been ripping last week, up 8%. So maybe we see something similar in gold. Our strategy compass, though, is flagging to buy puts. Obviously, because it's had such a big run, gold, it's at the top end of the Bollinger Bands, and the volatility is very low. The implied volatility has come all the way back to the lows of the range. which you can see here in our volatility dashboard, where we show, all the metrics that we think are important in terms of vol, and you can see vols there back down towards the low end of the range. Okay, skew's pretty neutral on gold, around 0. So again, you're not paying a premium for the puts. And carry is pretty neutral as well, where gold is kind of realizing in line with its implied. So you're not paying this big implied vol premium that you would typically pay if we're heading into events that can move the market. So I do think that the gold market is kind of, again, underpriced volatility here. I don't think they're pricing in any risk premium for the events next week. Now, those events, they could well be catalysts to the upside or the downside. Obviously, just looking at the Bollinger Bands and looking at how much gold has come up, you might want to be bearish and buy puts. Personally, I'm not as convinced that buying puts is the trade here, whilst it may work spectacularly well if the inflation print comes high and we get a hawkish outcome. If we don't, I think gold could break out quite significantly. And so for me, the trade idea that I'm going to talk about is more the market neutral one. All right, that's it for today. Thanks for listening, everyone, and I'll catch you tomorrow.